So yes, there's been some confusion about this equation versus what I showed you last week. So the bottom line that I want to tell you is that what I was explaining to you last week is would give you the identical outcome to what that equation is. Okay? So this is how I teach statement of cash flows. I teach it on intuition. Okay? And this is how most people that I've worked with and know do statement of cash flows. Okay? That doesn't mean that if you want to memorize a formula and that helps you to figure out statement of cash flows, more power to you. Okay? What I will tell you is that if you only focus on memorizing a formula and not focus on any intuition, there will be many situations with statement of cash flows that come up that may not fit into an equation that you have to then think about. Okay? And what I think, and I actually didn't look at this with you, the statement of cash flow equation you got, I believe, is for the indirect method only. Okay, so what we were talking about, so then I was getting myself confused because I was like, what we were talking about was actually the direct method, not the indirect method, and we started getting on a discussion, I think, that took the indirect method and the direct, so I think that's why I realized there was some confusion about direct versus indirect methods within itself. But, so just, I don't want to, without getting too far ahead, in the investing section, do you remember what I told you to think about when you think investing section? Non-current assets, okay? And so I had said things like proceeds from sale of a fixed asset, okay? Actually, I even have it right there. Think non-current assets, okay? So I had what had happened last week. I looked at this very simply, and this is intuition versus formula, okay? So when I say proceeds from the sale of an asset, if you sold an asset for $80,000 that has a basis of $90,000, what did you sell it for? It's a really simple question. If you sold an asset for $80,000 that had a basis of $90,000, what did you sell it for? $80,000. That's what goes in the investing section of the cash flow. The way, with a formula, you have to take the basis minus the loss. 90 minus 10 gives you 80. It's exactly the same thing. That's what we were talking about last week. Okay? I'm just looking at it very straightforward. Intuitively, what did you receive? That's it. Okay? So again, that's how I do it. You have to do what works for you. In accounting, there's lots of different ways of doing something. Okay? I don't know what the best answer is. I can tell you how I do it. I can tell you how I've seen it done most of the time. Okay? So getting started again, so I want to go back over just the basics without getting into all the discussion of statement of cash flows and the different reasons that cash flow is important. We have here 3 sections: operating, investing, financing, like OIF, right? They're always in that order. And when you have operating, you want to think of net income. You want to think of current assets and current liabilities. When you think investing, you want to think non-current assets. And when you're in financing, you think non-current liabilities, stockholders' equity, and dividends paid. So that will help you to figure out where things go. Any questions so far? Yes. This is overall cash flows. I haven't gotten into direct versus indirect yet. You need to know these regardless of which method you're using. And let me ask you that on that topic, direct versus indirect. Which section is different? Operating only. Okay? But regardless of which section you're in, you still need to think these things when you're in each of those sections. Okay? So, direct versus indirect. Why is this not going? What on earth? Okay. So direct here, you're going to see things like cash received from customers, cash paid for administrative expenses. So when you think direct method, when you're looking at the direct method, what you're essentially doing is putting an income statement on the cash basis. That's what you're doing in the operating section. In the operating section, you're essentially putting an income statement on the cash basis. Okay? So you have to look. So there's a very different procedure for direct versus indirect, because on the direct method, you have to basically take an income statement and put it on the cash basis. And for the indirect method, you have to reconcile your net income to cash basis. You don't look at each individual line item and put it on the cash basis. You take your net income number and back out all the accruals to put it on the cash basis. Okay? And we talked last week about some of the benefits and advantages and disadvantages to each. A lot of you guys had said you thought that the indirect method was easier, which it is, definitely easier, and you'll see it much, much more frequently out there in the real world when you're doing accounting work, at least if we don't end up switching to requiring the direct method. Okay? The direct method is a preferred method, but hardly anybody uses it. I don't want to say nobody uses it because I have seen it, but it's not very frequently used. However, the direct method, like I said, is a preferred method because it actually gives you more tangible, usable information. This is how much cash we received from our customers, not this is the change in accounts receivable for the period. Okay? Although people who would be proponents of the indirect method, okay, would say that net income is our accrual basis number, and this actually reconciles back to cash. This is a totally different calculation that ultimately reconciles to cash, but doesn't take you from accrual to cash. It just shows you cash basis. Okay? And people who would say, also proponents of the indirect method would say, there's a reason we report on the accrual basis, right? The accrual is supposed to be a better method of reporting than cash basis. So why would you simply just report something on the cash basis? You should take yourself from accrual to cash. Okay? So again, just some reminder from last week. So, so let's move along from here. I want to skip this and just kind of, I want to skip the IFRS for now. So it's funny, I actually made a small change to this slide, and I will put this up. I looked at this and realized that this income statement was not actually put together properly. I don't know why, but it had some things in the wrong place, so I just kind of tried to fix it. So we have here an income statement and a balance sheet. Okay, and we're going to go through, we're going to start with the direct method. So the direct method, what kind of terminology would you see again in the operating statement for a direct method cash flow? Cash from customers,
Cash to suppliers.
cash paid to suppliers. So you're going to, so it's basically, and again, I said think income statement on a cash basis. And in the operating section, you're thinking net income, current assets, and current liabilities. And you had a question? Oh, my bad. Okay. On the direct method, what you're going to be doing is starting with the information on the income statement. So if you have to put together a direct method cash flow, in the operating section, you need to start with what's on the income statement. So your first step is to pull up an income statement if you're looking at the direct method. And you have to look at each item in the income statement, and you have to figure out what the corresponding balance sheet account is. Okay? So what essentially you're doing, you have to take each item on the income statement and put it on a cash basis. So right now, sales on an accrual basis income statement includes sales for which cash was received, and it includes sales for which cash wasn't received. Okay? And if cash wasn't received on a sale, what account did it go into? Accounts receivable. So you have to take your sales and you have to back out of your sales anything that's still receivable. Okay? And this is the methodology you need to go through for each different item on your income statement. So I had gone through this last week. I have T accounts up here. I don't know if that's helpful. I just wanted to have like different methods for you to be able to look this up. But if sales was $590, okay, and accounts receivable was 40 in the beginning and is 60 at the end, what was the change in accounts receivable? If it was 40 in the beginning and it's 60 at the end of the year, what's your change in accounts receivable? What's your overall change in accounts receivable? 20. Okay? So cash collected from customers is 570. Okay, so you have to back out the change in accounts receivable. All right, so what I was trying to do here, which again, I don't know, you can look at this and decide if this is helpful to you or not. I'm showing you the initial journal entry. What it would have been, you would have debited AR, credited sales. Once the sales were paid, you would have credited AR and debited cash. Okay, so ultimately, you end up really with a $20,000 change in accounts receivable for what's not yet received. With me? So you have 590 in sales. You would have received 570. Your end of year balance is 60,000. Your beginning of year balance was 20. Therefore, sales cash collected from customers becomes 570. Okay? So the next piece here, any questions on that? So direct method, you're taking each item on the income statement and you're putting it on what basis? Cash basis. Okay. So next, I have here cost of goods sold. I realize this should be changed. It should say like cash paid for merchandise. Okay, or cash paid to suppliers. Something like that, it should say. So cash paid for merchandise or cash paid to suppliers, whatever it is. That's what you're trying to get at. So when we buy supplies, there are different accounts that are impacted. So you're on the income statement, because I said when you're using the direct method, you have to look at every income statement item. So cash paid to suppliers, let me just back up here 1 second. Cash paid to suppliers, if you're looking at your income statement, which account would include payments to suppliers? COGS, right. I mean, I have it up there, right? But so we dealt with sales. Stuff we pay to suppliers is related to this cost of goods sold account. So we're going to start with cost of goods sold because we start with the income statement on the direct method. Okay? Now, if we pay suppliers for supplies, what accounts are impacted potentially? So we definitely know cost of goods sold, accounts payable, and inventory for stuff that doesn't actually get sold during the year. Okay? So again, intuitively, we can get there if you think about it. This is where we can end up. So if inventory goes up, think about the journal entry. If inventory goes up, you would have paid, let's just say you're paying for inventory. Okay, so you start with cost of goods sold, you add any inventory that you purchased, any increase in inventory during the period, and alternatively subtract any decrease in inventory. So whichever way it goes, any change in inventory. However, if you say, what's your cash paid for merchandise, you're adding any increase in inventory, but if you didn't actually pay it, if accounts payable went up, that means you didn't actually pay maybe for that inventory. Okay, so you have to subtract any increase in accounts payable or add any decrease in accounts payable because it could be that you paid something that was outstanding from a prior period. So the intuition here is you have cost of goods sold, you want to add you have to look at the corresponding balance sheet accounts. You add any increase in inventory, alternatively subtract any decrease in inventory. It will be one or the other. You are going to subtract any increase in accounts payable or alternatively add any decrease in accounts payable to come up with cash paid for merchandise. Okay? So now I'm showing journal entries here, which I actually really don't. I should really change this. So here, cash paid for merchandise, we end up at 319. When you add, so if we look here, we end up at 319. We have cost of goods sold of 300,000. We have a change in inventory of 14,000 and an accounts payable of 5,000. So let's look. So you have cost of goods sold of 300,000. Okay. We have an increase in inventory of 14,000, which means like the idea is you're thinking I paid for inventory. So inventory goes up. Cash paid to suppliers goes up. So 300 plus 14. And then alternatively, accounts payable went down during the period, which means you paid more than just that. You paid another 5,000. That gives us the 319 cash paid for merchandise. Okay? So what you always are doing, again, I want to repeat, you start with your income statement. You're going line by line here, and you are adjusting for the related balance sheet items. Okay? Are you with me so far on what I'm doing? Did you have questions on what I'm talking about so far? Okay? So, like I said last week, the statement of cash flow is more than anything else, is you have to think about it, what makes sense. Okay? Particularly on the direct method. Like the direct method, you are not going to be able to use a formula to figure it out. Yeah, I mean, there are little formulas I'm giving you, but you have to think about what the related accounts are. Yes? Yes. because you actually paid it. If accounts payable went down, think about what the journal entry would be. To decrease accounts payable, what are you doing? Debiting it or crediting it? If you're debiting accounts payable, what are you likely crediting? Cash. So cash went down. Right? So you want to think, you can think about this in terms of journal entries. What likely, if accounts payable went down, what likely happened? If inventory went up, what likely happened? You debited inventory and you credited cash. Or accounts payable, which is why accounts payable is a related account here. Got it? Okay? So you're using things that all fit together. The same way with sales, when you think about this, if we go back to like an easier one, which is sales, when you think about sales, if you make a sale, what are the two journal entries you could possibly make? You're crediting sales, you know that. What would be the debit side of the entry? Cash or accounts receivable. If you debited cash, you received cash. If you debited accounts receivable, you didn't receive the cash, so that sales number is on the accrual basis. You have to put it on the cash basis. So you're backing out those sales. So if accounts receivable, the change went up during the period, you back that out of sales. Okay? So next. So let's say, next we're going to look at, I want to get into intuition here. So next we have salaries expense. We have salaries expense of 216. What would you be looking for? What would be a related balance sheet account? Wages payable. If you had an increase in wages payable during the period, what would you do? Decrease the expense. I'm trying to get you to think, how do you put something on the cash basis? Because you have one of two things that could have happened. You could have debited wages expense and credited cash, or you could have debited wages expense and credited wages payable. Okay? This is cash basis. This is accrual basis. You have to back out the payable. So is there a wages payable up here? Can you even see that? Can't really see. Wonder if I can do... No, it's not going to work on here. Okay. There's no wages payable on here. Okay? So wages, it is what it is. It's 216 for the period. Now, depreciation expense. What do we do with depreciation expense? This is kind of a trick question. Nothing. Does it have any cash impact? No. On the direct method, you just ignore it. And that's important because it's not that way on the indirect method. Now, I want to continue down this road here for another minute, and then I want to, because the reason I'm not going forward to show you where it fits on the statement of cash, there's a specific reason why I'm not showing you that the 216 is the final number for wages, okay? So, next, gain on the retirement of debt, loss on the sale of plant assets. Do these have a cash impact? Where do we see the proceeds from the sales of these items? Investing or financing. Okay? So here, these again have no cash impact. But we do use them on the indirect method. On the direct method, we ignore them because they don't have a cash effect. And we're directly arriving. All we're doing is putting an income statement on the cash basis. That's all we're doing is an income statement on the cash basis. Yes. It will be either investing or financing. So these three items, depreciation, gain, and loss, are ignored on the direct method, but we're going to be used on the indirect method. Loss on the sale of plant assets. I'm going to put this correct slide up for you. I'll put the corrected income statement up for you, or I'll just put the new slides up, whatever it is. Okay. Now we have interest expense. Interest expense, again, what would be one of the two journal entries that you would make for interest expense? You would debit interest expense and either credit what? Cash or interest payable. You're starting to see a pattern here. So what corresponding balance sheet account are you concerned with to put interest expense on the cash basis? Interest payable. Here we have interest payable. Interest payable went down by $1,000. What does that mean? You paid more. So not only did you pay $7,000, you also paid another $1,000. So you have to add it. So your total cash paid for interest is how much? $8,000. Good. Next, we have income tax expense, $15,000. What are one of the two journal entries that you could have made for income tax expense? You could have debited income tax expense and credited cash, or you could have debited and credited income taxes payable. So is there an income taxes payable account here? Yes. Yes. And what happened? It increased by $10,000. What does that mean? You paid less, right? You actually, so you have a $15,000 expense, and the payable increased. So you have to subtract it. Okay? So like you can think of the journal entry here. I mean, this is I'm trying to make this as simplified as possible. So if income tax expense is $15,000, somewhere along the line you made a journal entry to debit. You debited income tax expense, whether in one journal entry or multiple journal entries. You debited it for $15,000. So, and income taxes payable went up by $10,000. So somewhere along the line you definitely credited income taxes payable by $10,000, right? Does this journal entry balance? No. What probably happen with the other $5,000? You probably paid it. That's the idea here. So the idea here, of the $15,000, only $5,000 of it was actually cash. So if you take your $15,000 in expense and subtract the increase in the payable, you end up at that $5,000. You've now put income taxes payable on a cash basis. Does anyone have a question on what I'm talking about? Have I lost you? Should I go back over this? Cash paid for income taxes. That's on your operating section. Okay, I'm going to move forward for a second, then I'm going to go back. So let's look at that. We just went through a few numbers here. Oops. So cash paid for interest and taxes, I clumped them together. So we had $8,000 and $5,000. There's your 13 total. With me? That would be your operating section. These can be listed separately. I have them clumped together. They could be listed separately. Cash paid for merchandise, we went through. Cash from customers. Now, cash paid for wages and operating expenses was $218. What was the number of wages expense? $216. So why is it $218? That is the question. Right, there's something missing for $2,000 that we have to deal with, right? Even more simplified than that answer. That's a very good answer. It's even more detailed than what I was asking for. So here, we've now gone through. I said when you do the direct method, you start with the income statement. We basically worked our way down the income statement to every single line and determine whether or not it has a cash impact, and whether or not, if it has a cash impact, if there's a related balance sheet account. Now, we also, if you look here, we went through looking at the income statement, we looked at things that were happening on the balance sheet, all these accrual basis items. So cash, obviously, we don't incorporate cash into the cash flow. We arrive at cash. Like that is, that's the ultimate number that we're getting at. Accounts receivable, we dealt with through what was the corresponding income statement account? Sales. Inventory we dealt with. What was the corresponding income statement account? Cost of goods sold. Prepaid expenses. Did we deal with that? No. Things that make you go, okay. Or my phone goes off, okay. Oops. How do I turn that off? Okay. So prepaid expenses, sometimes you have items like insurance that you pay for up front that maybe you didn't expense by the end of the year. Maybe there was no expense for it. Maybe you prepaid an item. It's part of what your regular operations are, but you actually didn't have any expense, so you don't have an expense to relate to the balance sheet. So there is an additional step here where sometimes you have to look at what may be missing from the income statement that does have a cash impact, because when you prepay something, what happens? Cash goes down. I prepaid it. Cash went down. I actually paid a bill, but I didn't expense it. So that item has to be added to cash paid for operating expenses. So you have the 216 plus the change in the prepaid. Okay? Now, let's just continue down a little bit longer because I want to make sure I point out some important things here. So next we have long-term assets. Did we do anything with that? Why? It's investing. Very good. That's what I was looking for. It's investing because it's non-current. We're only concerned with what's in current. So non-current wouldn't be impacted in the operating section. Okay? So I'm trying to get you to think and apply back to the rules that I gave you and the intuition that I'm trying to give you to go through a statement of cash flows. So now you look at the current liabilities section. You have accounts payable. Did we address the change in accounts payable? Through what? Cost of goods sold. Cost of goods sold. Interest payable. Did we address that? Through what? Interest expense. Income taxes payable. Did we address that? Through what? Income tax expense. Bonds payable. Did we address that? Why? Financing. Great. And same with stockholders' equity. So now you've methodically gone through the income statement in order. As I explained, that's where you start with a direct method income statement. You've associated it with its related balance sheet item. And then you kind of just did a check. You went through the balance sheet, and you recognize you've now accounted for everything once you had dealt with the prepaid. Okay? So here, again, these you can look at if it helps you, but I feel like for the purposes of what we're doing here, it's more helpful to talk it through. Now we have cash received from customers. We agreed on how we arrived at that. That made sense. We got cash paid for merchandise. We agreed on how to arrive at that. What three accounts are in this one? Cost of goods sold, accounts payable, and inventory. So if I start with cost of goods sold, what do I do with an increase in inventory? Add it. What do I do with an increase in accounts payable? Subtract it. Because that means I didn't pay. Didn't I just put that on? Oh, it was you. Oh, I was like, well, now I guess I can't say anything, so my phone just went off. Okay. So that will bring us to cash received from operations. Any questions? Yes? Prepaid expense, here, cash paid for wages and operating expenses. So wages was $216, we added $2,000, now the total is $218. Okay? Because prepaid expense went up. That means we paid something. Any other questions?
Do we have, can you separate cash paid wages and operating?
Yes, totally. Yes, absolutely. This is just clumped together. Okay? Any other questions? So I'd like to try and have you guys do one, very simple. Well, it's not simple, but I mean, without like a huge amount of information. So why don't we try, I added brief exercise 23-4. So take a look at brief exercise 23-4. Let's try this direct method income cash flow statement. In the operating section only, I think is what's having.